I can actually mathematically take the S&P 500 now and break it down over time using these instruments. So as opposed to buying a whole market, which is essentially one dividend strip in perpetuity, I can overweight just like you trade the yield curve. So if you have a methodology, not just to price it, but to trade it and isolate it, then I think it opens it up.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, I'm Rick Silva of Metaurus Advisors, and we believe there's a different way or alternative way to think about and look at the equity risk premium using the dividend futures market. And I'm here to talk about that on The Derivative. Good afternoon. Thanks so much for having me. I'm Rick Silva. I'm with a firm called Metaurus Advisors. We are a boutique asset manager. The Metaurus Advisors it's an interesting place. So we're small. There's about 10 of us, and the principals at Metaurus. We actually first met in the very early 1990s at Merrill Lynch, and we were part of the team that built Merrill Lynch's equity derivative and structured note business. And then we left and we went and we did that again at Morgan Stanley. And then we did it again at Wachovia, and then we did it again at Wells Fargo. So we've been involved in derivative markets for the better part of the past 35 years. And so the idea behind Metaurus is we wanted to kind of continue to look at the same spaces and solve the same problems for investors, basically helping them understand what markets they can look at in order to identify and affect interesting trade-offs of risk and return, so they can build better portfolios for the most part. So the first thing we did at Metaurus, which kind of leads us to where we are today, is we looked at a lot of the technologies that existed in fixed income, specifically in this area of securitization, where the marketplace is very comfortable taking an asset like a bond, and breaking it up into its component cash flows. And they're also very comfortable taking a portfolio of bonds and carving up different risk tranches off the back of that. And it's brought a lot of liquidity, and I think it's added a lot of value to the fixed income markets. It's not been without risk, right? I mean, remember 2008 and some of the CDO squareds and things like that. But a lot of those technologies have never really migrated over to the equity markets. And so one of the things that we spent a lot of time at Metaurus thinking about, and this goes back, over our years together at all these different firms, is, what are some interesting ways that we can take some of those technologies and bring them into the equity markets to help make those markets more liquid, more efficient, to carve up new and different ways to allow investors to express risk and return views. And so the first thing we did.
Why do you call them technologies?
What's that?
Are there structures or technologies?
Well,
you think of them one and the same.
Well, I'll give you an example. So the first thing we did at Metaurus was, you're probably familiar in fixed income. You can take a bond and I can strip coupons from the zero coupon return of principal. That's basically a parallel tranche securitization, where I take an asset and I create two different interests in it. So investor A owns the coupons, investor B owns everything else that's left over, the return of principal. So that concept we thought was really fascinating, and could it be applied to equities? And practitioners have thought about doing that, of stripping an equity asset apart, stripping out the dividend cash flows or the cash flows over time and leaving the residual. And so that was the first thing we did. We did a parallel tranche securitization on the S&P 500. And we used the dividend futures market. That's the marketplace that had evolved from an over-the-counter market to an exchange-traded market that allowed us to do that. But before we get into that market, at a concept level, we took the S&P and we created two, effectively, ownership interests or economic interests in it. One ETF was a 10-year dividend strip. The price that traded at reflected the present value of the markets, the implied dividend expectations. Over time, it paid out the actual dividends. So you bought implied dividends, you received actual dividends, and you bought implied dividends at the risk-free discount. So what that was actually a way to begin to kind of carve up the equity risk premium. The other piece was the market without the first 10 years of dividends, so the strict market. And what's interesting when you do this, number one, you're taking the S&P 500 and you're breaking it into different risk profiles now, right? It's because the two together, if I bought one of the dividend strip and one of the market and I held them, and it's kind of boring, but I will have just recreated the S&P 500. And so you break it apart. You don't just break apart the cash flow and growth profile, but you're breaking apart the risk and return profile. So that's where we started. We
Isn't it weird, real quick? It's weird to think about if you read anyone who's pitching you on owning stocks, it's like you are getting the future earnings growth. I guess that's reflected in the price. My thought was going to, like, if you're just owning the dividend growth, that's sort of equivalent to the earnings growth, or no?
No, it 100%. It's another dynamic because the earnings growth is implicit, and then you have how much of that earnings are going to be, those earnings are going to be returned via dividend. But like the whole thing, when you price a bond, okay, it's nothing more than it's a discount cash flow analysis. Okay, so a 10-year 4% coupon bond is just a promise to pay $140 over the next 10 years.
Yeah.
Value of the bond, just the market, what the market's debating is what's the right discount rate to use to discount each of those cash flows, right? Well,
ignoring credit risk and everything.
And everything. And so if you move out on the credit curve, that's right. It's not just a risk-free rate. You have a credit spread, and that credit spread is the credit risk premium. And it's identifiable and it exists over time, right? There's a 1-year credit spread, a 2-year credit spread, a 3-year credit spread. And you've had instruments now that have developed where you can trade that credit spread in isolation. I can trade it in the investment grade bucket. I can go trade CDS, things of that nature. But for fixed income investors, the idea of time and duration is fundamental to the portfolio construction process. It never was in equities. And part of the reason for that is, companies borrow debt at every conceivable maturity, but they don't, JP Morgan doesn't have a 5-year class of shares and a 10-year class of shares. They just have JP Morgan stock.
Yeah.
So even though, just like a bond, a stock is a financial asset, it's a claim on the future earnings of the company, and dividends are how companies return those earnings to investors. The price of a stock at any moment in time reflects the risk discount to present value of all of its future expected cash flows. And so what you're talking about, which is the implied, growth, that is really fundamentally, that's the equity risk premium. And I laugh because, there's a ton of academic work, and we've had the very good fortune of working with, one of the leading practitioners, a gentleman named Professor Van Binsbergen, who's down at Wharton. But, he tells this story where he says when he teaches finance, they spend the first 2 weeks doing discount cash flow analysis and how to price bonds and stuff. He said, then, we turn the page and we move to equities and we do the dividend discount model where, I basically have a dividend, I have a growth expectation, and then I price it like a perpetual annuity. And he says, I can always tell the smart students because they'll raise their hands and say, wait a second, we just spent 2 weeks understanding for a series of known cash flows that there's a different discount rate, a different credit spread at every point that you use the discount. And now you're talking about a variable cash flow asset, and there's only one growth rate and one discount rate. So he wanted to dig into that. And that's the basis for his work. But
that's the crux of the whole problem, right? The bond has a fixed term.
That's right.
And so is it just, hey, this was too complex in the beginning to figure out for most people, so we came up with a different model, right?
Well,
fixed term versus infinite term?
So it does, but I mean, I guess you have to ask the question, is there a spot in the equity markets where you actually price term equity cash flows? And the answer is there is, and it's in the equity derivative marketplace. And if you think about all the options and futures and structured notes and things like that are traded out there, they're all linked to the price return of whatever the underlying equity is, and they all have defined terms. And so if you're pricing a call option on Microsoft, right, you know what the payout is. But if you're buying the call option from me,
guys, you're putting timeframes on that infinite timeframe via futures, via options, via. Got it.
Exactly right. If you were to buy the call option on Microsoft and I'm selling it to you, right?
Yeah.
Implicitly, my hedge is to go long some amount of Microsoft stock, so I'm going to receive that dividend. So I need to think now, where am I going to price that dividend? And so that happens in structured notes, options, futures. The implied dividend is embedded in all of that. And so that market became very, very, very large. It was the over-the-counter dividend swap market. And then after the financial crisis, it moved to a cleared format. They started listing essentially these dividend swaps on the exchange.
And before that, groups would be market making, selling options or whatever, needing that dividend exposure. So they would go to the swap market and be like, hey, can you give me a swap on Microsoft dividend growing more than X?
Exactly. Or go the other way where, if I was doing a structured note 3 years and I had to figure out, okay, how much credit am I going to give for the 3 years of S&P dividends? I would price it. Then I'd say, I don't want that, right? I'm an options guy. I want to get paid my premium in cash. I don't want to get paid in future dividends. So then I would turn around and find a place where I could offload it. And so I would try and sell that risk to insurance companies, pensions, hedge funds, institutional investors who get paid to take that.
And when the market makers do both, so they're owning that Microsoft stock and hedging the dividend out, or neither, right? It depends on who they are, but yeah.
Yeah, no, that's absolutely correct. But so that market, which started, grew up off the back of the equity derivative marketplace, it became very, very large. But it was actually what it allowed was visibility into how the market at a consensus level prices equity cash flows. How does the market think about the term structure of equity returns? And I was talking about Professor Van Binsbergen. He went in and he looked at this historically using over-the-counter. He had some proprietary data that he was able to get, OTC swap, dividend swap books, the marks on that. And then in 2009, they first Eurex listed dividend strips on Euro stocks. Japan did it in 2012, and the CME listed in 2015 on the S&P 500. But you now have this whole marketplace of dividend strips. And so, if you go back and you think, okay, a bond is nothing more than a claim on a future series of cash flows, a fixed rate, fixed term annuity. I know easily how to price that. And as you pointed out, the complexity in equities was that it's variable rate, right? Dividends aren't guaranteed. They're linked to earnings. You could have earnings can go down and dividends won't change. You could have earnings rally huge and dividends might not change. And they're perpetual. And so how do you price it?
But until they're not. That's the other piece. They're perpetual until they say we're suspending dividends or whatever. Yeah.
Just suspend their dividends. And then what that does, though, is that is really a reflection of an extension in duration in the marketplace, right? Because now I can take the S&P 500 and I can price it just like a bond. I can take that dividend strip market, which, by the way, they're already risk discounted prices, right? Like if we were doing, it wasn't sophisticated, but 25, 30 years ago, if we were trading something on the S&P 500 and the expected yield was 275, I'd have to figure out, where am I willing to take that risk? Where do I think I can sell it? What kind of discount? That's the same thing as a credit spread, right?
That's how
do I want to discount JP Morgan versus JetBlue? Where do I want to discount S&P versus a single name, right?
So to summarize, you have two fixed calculations. On the bonds, easy. This is the present value of that future cash stream with a defined endpoint. Equities, I've got this strip of dividends, which I'll put a defined endpoint on it, even though it's not defined. Those are two easy calculations. Now, on the bond side, the trick is credit risk. On the equity side, the trick is dividend risk, for lack of a better term. Or what do you call that? Of like, are they going to grow, suspend, decline? What is the dividend rate?
That's right. We call that the dividend risk premium, but really what it is it is the equity risk premium. And so you could take that dividend strip, that 10 years of dividends on the S&P, and they're already risk discounted, right? Because that's the market traded prices. That's if you asked an analyst, like historically, dividends over the past 75 years in the S&P, they grow at about 6%, call it, right? In up years, it's 7%. There's been 6 negative years. The average negative year, but for 2009 was negative 1.6, right? So it's a fairly stable asset. But if you looked at where that growth was trading in the market today or recently, it's pretty close to zero. So that's the discount. So they're not forecasting a lot of growth in dividends in the marketplace because that's where they're willing to buy and sell that risk. Right.
Is it sort of like they're just punting on that? Like, I don't know what that is, so I'm just going to price it at zero growth and see what happens?
Well, I analogize it to credit spreads, right? I mean, are they punting when JP Morgan credit spread is 40? Should it be 40 or 50 or 60? I don't know. right? If the risk environment changes, credit spreads widen. If treasuries go from 0 rates to 6%, high yield spreads aren't going to be 200 basis points, they're going to be 500 basis points. So it's a risk market exactly in the same way that is. But if you took the first 10 years of dividends and you discounted them using the treasury rate, right, just the present value of what they were, and you came up with that number, you added them all up, and you compare that to the value of the S&P 500, that dividend strip, the value of it represents the first 11 years or 10 years of the S&P 500. So if $100 of S&P, if the present value of the first 10 years dividends was 12, then 12% of the total market value is attributable to dividends, to cash flows in the next 10 years. The difference is the residual. That's attributable to earnings and dividends in years 11 and beyond. So that was iDividend did. That was taking the market and breaking it up over time. So what's interesting, there's a bunch of stuff that comes off of this. Now we could talk a little bit about
and this is all, I guess this is all known math. This is out there. This isn't anything proprietary. This is how dividends work and how it's all priced in the swaps and now in the futures.
Yes, that's right. That's right. But what's new, and it is known, I mean, it's visible, right? And the markets move around. And if you looked at like the growth rate in the US right now is slightly positive. If you went and you looked at the UK or Europe, it's significantly negative. Like the dividend strip looks like, it falls off a cliff. Japan is pretty normally sloped. So, these different markets trade and discount those equity cash flows based upon the perceived risk in those markets. One of the senior guys in the group said, "Hey, Rick, go figure out what the equity risk premium was for the past 3 years." And so I was like, "Okay, great." And I was like, "I have no idea what the hell the equity risk premium is." I looked at somebody else in the group, and a smarter guy than me. I said, "What's an equity risk premium?" They said, "It's easy to figure out. Just go figure out what the total return of the S&P was each year for the past 3 years, and then compare that to what the yield was on a 1-year treasury in each of those years. And then that excess represents the risk premium, right? The risk premium is just how much excess return do I require or do I expect to earn in order to take risk beyond the riskless asset, right? A credit spread is a pure isolated risk premium. It is the credit risk premium. JP Morgan is trading at 50 basis points over treasuries. It's 50 basis point credit risk premium. So I did that exercise and I got an attaboy and, things were good and went on with my life. And then, 30 years later, we're looking at these dividend markets and we're reading the academic research. And if you think about it, if you're talking about the credit risk premium, if I asked you, where is the 5-year credit risk premium for JP Morgan? Would you take a 5-year JP Morgan bond and compare it to a 3-month T-bill? You wouldn't.
No. Yeah.
Different duration assets. I compare the 5-year JP to the 5-year treasury. I compare the 1-year JP to the 1-year treasury. And so you actually have a term structure of credit spreads, right? People used to think of the equity risk premium as one number, but it's
just above cash.
Just above cash or 3-month T-bills or 1 year.
Yeah.
But the reality is now, if you want to try and understand what the 1-year risk premium is, I have a 1-year dividend strip and I can compare that to a 1-year treasury and I can see how did that perform. And if the market is the present value of all of its future cash flows, then the total equity risk premium is the aggregation of all the individual risk premiums. So when you go and you start thinking about what is the equity risk premium, it forces the question, what is the fixed income counterfactual that you're trying to compare it to, right?
Or what's your time frame? Like, great, there's no just one number. What is it over X? What is it over Y?
Exactly. And if you're trying to do the whole market, the exercise is, well, what's the duration of the market? Because that's the treasury that I need to compare it to, right? Now, we don't have 50-year duration bonds in the US, but if you went back, so what Van Binsbergen and his partner, a guy named Ralph Koitchen, who was at Chicago, what they did is they went into the equity marketplace and this dividend strips market to understand historically how has the market discounted equity cash flows? What is that risk environment? What has it been? And so they created, just like you would in fixed income, a 1-year constant maturity, a 2-year, a 3-year, a 4-year, all the way out the curve, right? As they did a 1-year constant maturity dividend strip, a 2-year, 3-year, and they did this across a ton of markets, right? Japan, Europe, UK, US, and they looked at the risk return profile of it. And then when you aggregate it all up, it forces you to look at the market risk premium. You have to compare it to a very, very long duration fixed income asset. So in the US, you would compare it maybe to a 20-year bond or a 30.
Yeah.
It would be about as close as you could get. But what they understood, or what kind of emerged from the research, was the distribution of that risk premium was not what they were expecting. In fact, shorter duration equity cash flows offered higher risk premiums, generally speaking, than longer duration equity cash flows. So they were more heavily discounted versus expectations and versus outcomes. So now you have what used to be thought of, like if you talk to a bond guy or a credit guy, right? They talk over it. It's about the continuum of time. Like, where's the best place to be on the yield curve? Where's the best place to trade credits? You can now do that in equities. And so this is, off the back of that original IOPO, this is some of the stuff that has been opened up now. And so these are some of the markets that we've been looking at.
It's interesting. Like the word risk premium gets thrown around an awful lot, right? So a lot of people just be like, there's a risk premium in equities because they can go down.
Yep.
Right? They're just saying that's why it goes up and use the word risk premium without any stats. As you said, it just could be the simple, it's over cash. But you're saying no, it needs to be considered in each time frame, like a bond, like a strip of 2 years, 5 years, 10. Interesting. All right. I'm gonna noodle on that for a sec. So back up real quick. We shot through your bio there quick. So you were at, rattle those off again. Merrill, Wachovia.
I started at Merrill, and then I did a short stint on the buy side. Then I spent a bunch of years at Morgan Stanley, then went over to Wachovia and Wells Fargo. That was my substantial sell side background before reconnecting with.
But that was sort of the same adventure we were just talking through of like learning the bond structure, term structure, and then moving into the equity term structure.
Yeah, working across asset classes, working across geographies, understanding basically derivatives, derivative risk, financial pricing. How do you price financial assets? What are the techniques used to estimate future cash flows, forward cash flows? How do they trade? How does the risk market look at them?
And what would you say? I'm sure I've had plenty of hedge fund guys on here who would be like, discounted cash flow model is BS, right? Or if like trying to even price these securities is BS. Like, they either go up or down. There'd be animal spirits, systematic, intraday trading, whatever the thing is. They don't care about what the discounted cash flow is. So like, how do you square that with like actually trying to get a price?
Well, the price is the price, and if you're talking about bonds, it's there, right? You can see it. You know exactly the different components that you can trade, and so can it go up? Can it go down? Yes. Why do credit spreads widen? I'm not smart enough to figure that out. Only in hindsight can you figure that out, right?
Yeah.
Why do equity markets move around? Lots of different factors factor into it. But what I believe and what I think is true is the price of an equity at any moment in time reflects, right, a market consensus. I'm not saying whether it's rich or cheap, it can go up, it can go down, but it's a market consensus of the risk discounted present value of all the future cash flows. That's it. And now that we have this dividend market, what I can say is I can trade it. So it doesn't matter what people think. And I still can't explain why it goes up and why it goes down. But I can actually mathematically take the S&P 500 now and break it down over time using these instruments. So as opposed to buying a whole market, which is essentially one dividend strip in perpetuity, I can overweight just like you trade the yield curve, right? Just like you build a fixed income portfolio. It doesn't mean you're going to get it right. It doesn't mean, you were targeting a 3 duration, it should have been a 7 because that's what the environment turned out to be. But I think these cash flow, that's all a financial asset is. So if you have a methodology, not just to price it, but to trade it and isolate it, then I think it opens it up. And
I think their argument, my fictitious bogeyman here, would be like that it doesn't matter what you think the price is, which is essentially what you're saying too. The price is the price, but you can get into a lot of trouble with your model saying, no, this is the correct price. And it's right, infinitely higher, infinitely lower, and you're trying to sell into that or buy into that and get into a lot of trouble. That's, I guess, my point of
Yeah, no, and that's fair. And I would analogize it like this. Like I would say, if we were talking about volatility markets, right? I don't know where the heck the VIX is today. Say it's like a 21 or whatever. Um, that's the price of the VIX. That's the cost of insurance. Is that the right price? I don't know, but I know that's the price. And so with the dividend strips, my comments on discount cash flow analysis are less about is the risk premium accurate or inaccurate, but I can now identify it. And if I have a basis for reasonable, forward expectations, whether that's through, sorry, someone popped on my screen, whether that's through forecasting models, bottoms up analysis, and I can see where these things are trading on the screen. Like the same way people buy, you want to buy high yield, you want to buy investment grade. I don't know. Where do you think you get the better risk return opportunity? Right.
Yeah.
So it's a subjective assessment of the risk and as close to an objective assessment of the return as it possibly can be. And in equities, you never really had a very objective assessment of return. And now I'm saying you do more and more with this marketplace.
And that allows you to do things like sell the front month, buy the back months.
Yeah,
I'll use air quotes for the listeners, but basically, right, if you can separate those into time frames with the dividend strips. Yeah.
Same way you would trade build a credit portfolio, right? Like a duration neutral credit portfolio over time. We do that. We do a couple things. We have a public ETF that we do in partnership with a wonderful company called Pacer Financial. They're the cash cows guys. If you've ever come across those guys, they are they're awesome. You'll see them, Sean O'Hara. You'll see them on CNBC and Fox Business and stuff like that. But with Pacer, what we do is we essentially isolate a 3-year dividend strip from the S&P 500, and then we over allocate to it and under allocate to the S&P 500. So if you go back to the IDIV XDIV, the 10-year dividend strip and the market without the 10 years, remember, if you put them together, you just recreated the S&P 500. But if you put them back together in different ratios, you've now changed the cash flow and growth profile of the S&P and you've modified its risk return profile. So that ETF, we actually pay out the actual dividends as they're earned. And so that makes quarterly distributions at a rate of 4 times the actual S&P dividend yield. And it has a market beta of about 90, and it has a volatility profile between 80 and 85% of the S&P. So it's a very growthy, very risk efficient growth and income strategy. That's one thing we do, right? And that's mostly geared for investors who are looking for market beta, but who want to tailor their kind of growth and income and risk return profile.
What's the symbol? Are you allowed to say?
What's that?
What's the symbol?
QDPL, quadruple, for 4 times the dividend.
Got it.
And we rolled it out on NASDAQ.
But you're 4xing the dividends, or no? You're only, what'd you say, 120 to
4xing the dividends.
So you're owning 4x the dividend strips.
Yep.
And how much of the S&P?
About 85%, 85 to 90%. You're all in beta. So what we're doing is we're taking that annuity profile and we're pulling it forward for you a little bit, so you can harvest more of the earnings and dividends in the early years. You'll get less of it in the later years, right? So the portfolio for $100 of quadruple, I'll literally hold $85 in the S&P 500, and that gets me 85% of the dividend. And then for $15, that's how much it cost me to go into the strip market and fully pay for another 315% exposure to earnings and dividends in years 1, 2, and 3.
Right.
Put together, I get 4 times in years 1, 2, and 3, 85% in years 4 and beyond. So as opposed to tilting sectors or selling calls and things of that nature, we're just time weighting the S&P. We're shortening the duration of the market.
Got it.
So that's one thing we do. We also have a strategy that you guys are familiar with, where when Van Binsberg and Koichin went in and they started looking at the individual strip markets to say, how does the market systematically over time, or do they systematically or persistently, how do they discount cash flows? Because it's a big market. So whether they're intending to or not, things will emerge from it. And what they found is that shorter term equity cash flows offered higher risk premiums than longer term equity cash flows, right? So if you think of the market as one risk premium, equity risk premium, you wanted to break it up over time, more of it would sit in the front end and less of it would sit in the back end.
Just simply because of future uncertainty?
There's a bunch of reasons. There's some market structure reasons because most of the derivative flow is in the short end. So there are more natural sellers in the front than there are in the back. But it's still a risk asset. So you still should have a risk premium. The other reasons are there's a left tail, right? If I'm long 1 year dividend and it gets cut, right, I'm going to realize a loss.
You don't have time to make it up. Yeah.
There's no recovery. So there's a left tail there. You're getting compensated for the left tail. But they looked at this, and it also has a much lower cap and beta. So
and I'm thinking of that reverse. So front end has a higher risk premium, meaning it's more cheaply priced.
yes,
Right. In bond terms, it has a higher yield.
yes,
Yeah.
Than the back end. That's right.
Okay.
And
because of that factor, the back end has longer to make up for any short-term hiccups.
Exactly right. Markets, individuals, you get into the behavioral side of it where investors are much more risk averse in the short run than they are in the long run, right? Everybody's worried that this year, the market's going to be down. If I said 10 years from now, what do you think? Oh, no, we'll be fine in 10 years. I'm not, if you're borrowing money, say I need to borrow money for 1 year, and then you say, let's make it 2 years. You're going to get a very different interest rate. If I say, borrow money for 29 years, let's make it 30. Okay, whatever. It's the same rate. But the dynamic they uncovered, and by the way, it's not what they were expecting. Higher risk premiums in the short end, lower cap and betas, which means if you take the S&P 500 again, which is all the dividend strips, and you allocate to the piece of it that with a higher risk premium and a lower cap and beta, and you under allocate to here, it actually has a higher Sharpe ratio. And so we run a strategy where we harvest the risk premium in the front end of the dividend curves in US, Europe, UK, and Japan. And there's a lot of stuff we incorporate that informs what maturities we're picking, how we're allocating across the geographies and things of that nature. But we go long the front end and we hedge out the beta, any residual beta there, by going short the back end. And the hedge ratio is like 20 to 30, somewhere in that range, generally speaking. And so we've created a beta neutral access to an equity risk premium, just like you would in a credit portfolio, right? You're trading bank loans or you're trading CDS. And that strategy's, knocking on wood, done very, very well. But back to Van Binsberg, when they discovered this, that's not what they were expecting, right? They thought, well, the longer the term, the more uncertainty, the higher the risk premium. And among the things that kind of help convince them that this is actually a very viable conclusion, and it actually is probably persistent, or really two things. Number one, that profile held across markets. So it's not like it was only the US or only Japan. So, right, it was consistent across equity markets. And the second thing is they went back and they started thinking about it, and they're like, wait a second, there's lots of other assets that have this same profile, right? Housing, corporate credit, volatility. And so it started to comport with a bigger picture of, other assets and had similar behavior. And so, and sure enough, like we've been looking at it, the data, the research goes back, 25, 30 years. We've been active in it since 2018. And that's when we launched iDiv and XDiv. And then we've been very active in it, post-COVID.
So, and then you mentioned volatility in my brain when you said harvested, right? I think of selling option premium. So does it have a bit of a negative skew, short gamma profile, right? Of like a COVID type, something bad in the front months is gonna hurt you?
It does. It has a left tail for sure. It's very safe as measured by cap and beta. So like in 2022, okay, fine, markets sell off because rates are going higher and there's inflation fears. Didn't impact anyone's expectation on 2022 earnings and dividends 23, 24. But what you saw in that scenario is people say, well, geez, the recession may come in 25, 26. So the back end of the curve sold off. If you go into 2020, what happened is
that was actually a good thing for you, right?
It was a great thing for us.
Yeah.
Right. So we're the risk in the strategy is the systemic risk. It's the COVID risk, right? Where all of a sudden the rate
9/11, COVID, some sharp and acute.
Exactly. Something that causes a reset of short-term expectations.
Yeah. But would you say less than being outright short, right? Less than that same trade in the VIX if I'm short front month VIX, long back month VIX?
Well, yeah, VIX, I would imagine, would have a lot more gearing in it. And we use actually that relationship in VIX to help inform the sizing of the strategy. And when you start to see distortions in the credit markets and in the volatility markets, those historically have been precursors to forthcoming events. The market has been pretty good setting up ahead of things. And so we use that to inform, maybe we should dial down the strategy a little bit in terms of notional exposure or leverage. We also have a commodity trend following strategy, which is a little bit different. But the other thing that we just launched, which it's actually not launched yet, but we entered into a partnership with the Chicago Board Options Exchange to roll out a series of futures contracts based on some technology. So in the very beginning, we talked about Dividend as a parallel tranche securitization. Remember, the idea is, what are things that the market is doing in fixed income that might make sense to kind of explore in the equity asset class? So IOs and POs are parallel tranche securitization. The next thing we wanted to tackle was sequential tranche securitization, which would be CDOs, CLOs, things of that nature, where I take a pool of assets and I basically carve it up into performance tranches. And if you really think about what is a CDO, right? It's a series of better of and worst of outcomes. And when you capitalize a pool of assets, the senior lenders get the best performing bonds, right? Said differently, the equity tranche gets the worst performing bonds. The first default eats into the equity. And as long as you don't have enough bad performers to eat into the collateral that's really sitting behind the senior tranche, then the senior tranche is fine. So we wanted to think about, how do we do that?
Is that after the fact in CDOs and two? Or before the fact? Like, do they pick out which they think are going to be the best, or it's by rule after the fact, the worst go into this bucket, the best go
so in a CDO, you start off, you pick what the assets are that you're going to benchmark to, but the outcome is ex post. So it's basically after you get to the end, right? It's only after you have a default that you have an outcome in the strategy. So we applied that same approach to equities. So we build an index. Without getting into all the technical stuff, it's basically, it's a 100 stock index. Each stock is equally weighted. It's the sector weightings are interesting. So the index itself actually has it's very highly correlated to the S&P 500. So it's only 100 names, but if you were to just buy that index, it would look and feel a lot like the S&P 500. But we basically created an equal weight S&P out of 100 names.
I think you could have just bought 5 names or 7 names and looked awful lot like the S&P 500
for the past 5 years, for sure. So we have this. That's the master index, and then we have off the back of that, there are 2 sub indices. One index is called the lead index, and the other one is called the lag index. So if you think about it, the master index,
those 2 tranches.
2 tranches, the best performers and the worst performers. And so the master index is a total return index where all the corporate actions are captured at the constituent level. So not reinvested across the index. And it's a horse race. And we run it for a quarter. And whatever the 50 best performing names are, I don't know what they're going to be until I get to the end of the quarter. Those names will sit in the lead tranche. Everything else, the 50 worst names, will sit in the lag tranche. And so what is...
As an index. And then there'll be futures on that index.
Well, we're going to list futures on the lead tranche and the lag tranche. So if you go to any investor and you say, okay, 3 months from now, would you rather own the best performers or the worst performers? Most people would just instinctively say, well, I'll take the best performers. Okay. The question is, how much are you willing to pay for that? Right.
So if that price gets bid up and it's no longer risk reward.
Well, you would expect that the lead tranche futures, the futures linked to the lead index, would trade at a premium to NAV. So on day one, the NAV of the index is 100, and the 2 tranches are 50 and 50. I don't know what names are in it, but each stock's worth $1.
Right.
As they move around over time, the NAV of each of the tranches has to equal the NAV of the index. The futures contracts, if the lead tranche is trading at a 5% premium to NAV, then in an arbitrage-free model, that means the lag tranche has to be trading at a 5% discount. Because those two have to also add up to the
index. Right.
So that's realized dispersion. It's realized return dispersion.
But not dispersion, as we talk about on this podcast a lot, of volatility dispersion, of dividend dispersion, or how do you define that?
So
I mean, or maybe they're one and the same because that dividend action causes the volatility dispersion.
Yeah, it's kind of the next level down. So most of the correlation indices and things like that look at, implied vol between the index and the constituent stocks, those are all implied to implied, but none of them have a realized outcome. And we actually have a realized outcome here. So you'll have a return. There's a beta in it or a delta in it. The pricing of the futures contracts will have to capture the implied vol in the market and the implied correlation in the market, because it's basically a better of and a worse of option, if you want to think of it like that, right? Over time, they're going to converge. But what's unique is it actually allows you to express a directional view as well.
They need to launch tell them next time you meet with them, right? All these RAs are selling these best of products, but like S&P, Russell, NASDAQ, like you get the worst of or the best of on the upside. Those would be interesting futures too, to allow them to hedge.
Well, these futures will be the natural other side of it, because the lead tranche, will have an embedded correlation exposure. The lag tranche will have the opposite side correlation exposure. So you can use this to lay off some of that risk.
Now, how do you think about in all this that you're doing with the dividends, the NASDAQ companies that don't pay dividends?
Yeah.
How does that work into the math? So if at all, or what, right? How do you price those? Go ahead. Whatever your comments are on that. That seems like a thorn in your side.
No, well, it's, with the NASDAQ, it will remain to be seen, right? Because NASDAQ dividends that's kind of has a lot of call option features. Like with S&P dividends, you'll have upside surprises, but most often it's a downside surprise, right? Where companies or sectors get whacked, or, financials cut their dividends, or you have that kind of stuff. With NASDAQ, just to give you a metric. So last year, I forget what the index itself was up. The dividend growth last year in the NASDAQ outperformed the index itself. So
really?
Percent. You had Google, you had all those guys declaring to Salesforce, Meta, Google, right? And there's only, I think maybe these numbers may be off a little bit, but I think it's about 80+% of the S&P 500 names pay dividends. With the NASDAQ, it's closer to 50%. So the play there is really...
Which is that up from like 10% 20 years ago? Has it always been?
Right? No, I could cheat and pull up my graph. I have it, but yes,
yeah, off the top of your head, but it's been steadily growing.
Steadily growing. And if you read the fundamental stuff out there, and you look at the environment, and there's a lot of pressure for companies to start to return capital. And as these tech companies get larger and larger, right? I mean, a lot of them are growing through M&A activity. Their revenue base, their sales are stabilizing. They have positive earnings. What do they want to do?
Basically, you're looking more like a S&P company. You need to start acting like it.
Pretty much. So that's NASDAQ, and we're looking at potentially doing it on some other international indices. But that could be a whole suite. We call it the dividend multiplier strategy. So with Pacer, we would do this in partnership with our good friends at Pacer. We have a suite of ETFs where investors can build their global portfolios, or advisors, RIAs, whomever. And if they're looking for growth in income, or if they want to dial down the risk a little bit or change the income profile of their portfolio, they'll have the opportunity to use this suite of ETFs to do that across markets.
Do you listen to the podcast Smartless with Jason Bateman and those guys? They're always saying for my sister Tracy, but I say for my friend George. So explain for my friend George exactly how the dividend futures work. Like, what are they quoted at? They're quoted as the growth percent or the dividend percent?
No, so they're actually quoted in dividend index points. So they list contracts. So they're traded on the CME. They have quarterly maturities, but we deal with the quarterly maturity. Sometimes a company's dividend moves from one quarter to the next. You can get moved around, right? But typically over a 12 period, it's much more stable. So they list the current year and the next 10. So you always have 11 years of contracts. They mature in December of their contract year, okay? And they're quoted in dollars, but it's index points, and then there's a dollar multiplier that brings it to a certain notional exposure. But the way they work, they're linked to something called a dividend points index. And so for the S&P 500, S&P publishes the dividend points index. And the way that index works is it begins the year at 0. So for instance, the current year, when on the third Friday of 2024 in December, third Friday in December of 24, the final value of that dividend points index determined the final cash settlement value of the futures contract. That next Monday, the index resets to 0. And then every day for the next 12 months that a company in the S&P pays a dividend, S&P takes the dollar value of it and based upon the company's weighting in the index, converts it to a number of index points. And it just tallies it during the course of the year. And so when you get to the end of the year, that futures contract, and today it's trading about 78, but the 2025 is trading at about $78. Whatever the total dividends paid over from December 24 to December 25 will determine the final cash settlement price of that contract.
So it's whatever, 78 divided by 6,000 or whatever?
Is the yield, is the implied, you got it. But you're buying the implied yield.
Yeah.
So people don't think about this, but if you looked on the screen, you say, okay, what's the implied yield? Where are these things trading? It's trading at like 1.25, roughly, give or take. The actual dividend yield on the S&P has been coming in between 170 and 185.
And they couldn't quote it in, right? They had to make it difficult, so normal people couldn't understand it. They could have quoted it in the percent yield.
We paid extra for that. No.
Right. So it's already 1.3% through, I guess, the first quarter. What is the yield?
So that's the price that you pay for it. So what happens is during the quarter, as that dividend points index accumulates, when we get to the end of the quarter, I know exactly how many dividends have been earned on the S&P 500. So
it's going to be 58 is how much has been received, and 20 is the
20 to go. So if we bought it for 80 and we get to the end of Q1 and it's at 20, that means $20 of risk has been taken out of the contract and it's been earned. And basically your remaining risk for the next 9 months is now 60. And what you'll see is those contracts will start at like 75, right? And then as the dividend points come in and affirm where the actual growth rate is going to be, the contract will migrate up and they will converge at maturity. And that's the dividend risk premium.
And so the 11-year out one's trading at like a tenth of that. Is my quick math at like 5, 6, 7, something like that?
No. So, I mean, I'll pull it up on the screen. So,
or it'll just get 10 times more valuable over the life of it.
No. That's the thing. The implied growth rate in those dividend futures contracts is like 1% per annum. So the 2000, it's about 77.85 right now, the 25. Okay. The 2032 is at 82.50. So what does that mean? Again, getting back to
that's weird. It should be.
Yeah. Well, what can I do with this information? If the S&P goes to the moon and that curve doesn't move, would you rather buy the S&P and pay essentially a massive multiple for earnings 10, 15 years out? Or would you rather buy exposure to earnings in years 1 to 10? You might get better value.
What did people use options to do this on individual names, right? Like Nvidia comes to mind, like I don't want to own it, so priced up. There's animal spirits in there, like can I just own the dividend stream instead? I don't know if they even pay dividends. Probably not.
If they don't pay a dividend, it would be tough to isolate it. But if there was a company and you'd rather exposure, you could isolate and strip the dividend out. But what's interesting is, the U.S. is a funny place sometimes. So you have the competing regulators, right? You have the SEC and the CFTC who constantly trip over each other in the space of derivatives, right? Is that a commodity or is that an equity? Who regulates it? So they can't figure out who's going to be in charge of the single stock dividend futures. So the Eurex lists them. So you can go into Europe right now. I think last I looked, there were 29 US names where you could trade dividend strips. They list them for 5 years typically. And in Europe, they list them on sectors. So, if you just want to take a view on the financial sector, maybe you want to sell it because that's like buying a put, right?
Mm. And talk through me globally what everyone's main index looks like. S&P versus
So
Euro stocks
S&P,
or whatever versus Japan. Like, what are those dividends running at right now?
yeah. So it's funny. So great question, by the way. In the U.S., as we said, it's basically flat in the early years and then very modestly upward sloping. You get about 1%, 1.5% growth per annum. Um, Japan looks a little bit like the US. Now, Japan isn't as liquid. They only list 5 years, and you really get, most liquidity sits in years 1 to 3. But that's normally sloped. And it actually just sold off today pretty significantly, but it's positively sloped a little bit, right? So it looks normal. If you ask somebody to draw what you thought the curve would look like, that it would look like what they would draw. If you go into Europe, it is upside down. It is massively inverted. No, it's inverted.
It's a W. Oh, it's inverted.
Not even a W. It's just a downward check. It's like an upside down check mark. And the UK looks exactly the same.
What's
So
the logic there? It's all going to be
risk
invaded
free.
by Russia. There will be no dividends ever.
It's just a risk market. I think they're just looking and saying, yeah, like I don't know what the prospects are going to be 8 years out. And so if you want me to take the dividend risk 8 years out, the regulatory environment, the geopolitical environment, all the stuff that's going on there, I need to get compensated to take that risk. So you have like, I'll give you, so this is in euros. So the euro stocks, I don't even know where the heck euro stocks is today. Well, it's about 5,200, 5,300. The 2025 contract in euro stocks is trading at 165, 166, somewhere in there. The 2030 contract is trading at 142.
But they generally pay a higher dividend in Europe.
They have a higher payout ratio in general, yes.
Yeah.
Yes. And the
So
yield
what
is higher, so the relative value of the dividend versus the index is higher over there.
and what do those payout ratios generally look like? S&P versus Europe versus Japan.
So historically, S&P is like, if you go all the way back, it's like
Yeah.
50%. Right now, it's like 25 to 30%. So we've had a huge period of earnings growth, and the dividend growth has stayed at 7, 8, 9%, but it hasn't matched what earnings had done.
Right. But
Europe,
I'm saying just the actual dividend on the S&P last year was what? 3.5? I don't know what the number is.
no. The actual in the S&P was about like 180 last year.
180. Got it. Versus Europe's maybe what? Double that?
Yeah, like it's over 2.5 maybe. Japan's over 2. But the key is the payout ratio, right? It's how much of the earnings are they returning in the form of dividends?
Yeah.
And then the yield is a reflection of the valuation of the market relative to that payout ratio.
Is that partly? I guess there's plenty of smart and well-heeled people around the world, but right, that partly of anyone playing in this game is just playing in it out of the US versus globally. So you don't
No,
get as
no,
much interest.
no. In the what Metaurus is doing, I think, is a little bit unique because we're looking at these markets to build portfolios and to create systematic, strategies that,
Yeah,
that
not
could.
purely hedging or whatnot.
Yeah, I think in other markets, there's a lot of hedging here. You could trade options on these things too. And like I know a lot of the Canadian pensions, the Scandi pensions, they'll look at this opportunistically. And so when you get a COVID event, so in COVID, what happened was the market sold off. The short-term dividends didn't really move because people were like, oh, okay, but then they sent people home from work. And then in Europe, they started jawboning about, hey, banks should suspend dividends this year. And then you saw a complete collapse in the front end of the curve in the US. The big sovereign funds came in and actually bought that. So,
Yeah.
so they'll wait for the left tail and they'll come in and provide that liquidity.
On the flip side of that, I know some long vol funds that actually will sell them as a long vol play, finding it cheaper to hold than right, buying puts or holding the VIX or whatever they're doing.
That is exactly right. There's no lost premium. There's a dividend risk premium that will erode over time, but you can simply look at, how much option premium am I going to spend to buy out of the money puts or to get exposure to VIX versus the dividend strips. So all these things should have relationship to each other.
We're going to finish up. What intriguing rabbit hole have you found yourself diving into lately, personal or professional?
Well, I'll tell you my rabbit hole, but I don't want to talk about it because I've been obsessed with this Doge stuff. Like
Yeah, all
I
right,
can't
let's
freaking
do
get
it.
enough of it.
Yeah. What Yeah. And where you're in Connecticut?
I'm in Connecticut.
So what's the mood there? Like everyone, what the heck is happening? What's going on? Or cheering it or panning it?
Connecticut's a weird place. You get it's funny because you get the outrage, like, well, what are they doing this? We need to, help the rest of the world, and we can't be cutting all this stuff. And then you actually point out the stuff that money is being spent on. They're like, yeah, well, that's stupid. We shouldn't do that. And
Yeah.
and so I mean, I give Trump credit because he finds the 80-20 issue. And he puts himself on the 80% side of it, even though the 20% side would be very loud. And even the 80% side might not realize that they're on the 80% side until they actually are forced to look at it. So I've been, and I don't know, there's this young woman who is a data scientist. She's deaf and has some physical challenges, but she's freaking brilliant. And Musk just hired her to the team. But she's been doing a ton of just data mining now that a lot of this data is becoming public. And so there's just so much. I mean, it's so discouraging in so many ways, but it's like, whatever, just the gore of it. It fascinates.
Yeah. Right. I feel like it was they could have promoted it a little better. Like we're going after the pork projects, the bacon, like all that stuff that is, to me, the fix is put it all, every single line item has to be voted on. That's the problem, right? They stuff all this stuff into one big bill.
Yeah.
Half the people don't probably even know what's in it as they're voting on it.
Yeah. No, I agree. Well,
Half of Congress, I'm saying, much less the Americans. Yeah. So by the time it gets to us, we're like, what are we doing?
Yeah.
But someone promoted that, someone wanted that in there for their own interest.
Their own interest, and remains to be seen how nefarious those interests are, but I'm sure more will be uncovered over time. But like one of the most controversial political things over the years has been the line item veto, right? Where you can send a bill to the president's desk and he can say, okay, I'm gonna sign this, but I'm gonna veto that, I'm gonna veto that, I'm gonna veto that. So they want to jam it all on the big bills, for exactly the reason you pointed
out. Tying it back, what does that do to what is this administration, Doge, right? There's been some ups, some downs.
Yeah.
What's that done to dividend markets? It moved?
It's moved them. Yeah. I think the market is trying to sift through, as the equity market has sold off, you've seen the back end of the dividend curve sell off, right? Because remember, all of them together equal the market. So if the market goes down, some of them have to go down. The front end has held up pretty well, but you're starting to see some risk evident in, if you look at credit spreads, if you look at the term structure of VIX and some things like that are starting to indicate that left tail risk is starting to kind of heighten a little bit. So you're starting to see some of the front ends sell off a little bit. We haven't seen anything material, but it definitely has us, very focused on that.
My rabbit hole is my son was reading Great Gatsby for English class, and he was asking me about it, and I started to pick it up, read back through it, and getting into all the green light and looking up. Now these days you don't just have to think about it and talk with your back. There's YouTube clips and whole blog posts on what all this means. So I was diving down into all that symbolism and was it really intended or was it not?
Yeah.
Which was somewhat interesting.
The rabbit holes that the kids throw you down are awesome sometimes.
Oh yeah.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.